Hello, I'm Los Angeles City Controller Ron Galperin, and I am so pleased to be part of the Los Angeles Public Library's continued work to promote financial literacy. All year long, the library, through its outstanding Department of Lifelong Learning, hosts life-changing programs that teach and support financial empowerment, immigrant integration and inclusion, and health and wellness. And the best part about it is that it's all free. As controller of our city, I make sure that public dollars are being put to good use, keeping our government honest, responsive, and accountable. Because people want to know and deserve to know that their government is doing its best to serve them. While it's important for the city to plan how we use our money wisely, I want you all to know that it's just as important for you to do the same. Because the city's financial health depends on the financial health of all Angelenos. The programs that the library is hosting this week and throughout the year are here to help everyone succeed and to make positive financial choices for our futures. I'm so grateful to all of our libraries and incredible staff, and VITA and its volunteers for all they do to ensure that you and your families have the tools and resources not only to prepare your taxes, but to help you be on the right financial track. Thank you.
Good afternoon from the Los Angeles Public Library. Thank you for joining us today for our presentation on financial literacy basics presented by Bank of the West. This program is one of several the library has hosted this week to promote financial literacy because April is Financial Literacy Month. You can view previously recorded programs on the library's YouTube channel, so just go to youtube.com/user Los Angeles Library. And if you have questions today, please post them in the chat. We'll answer them at the end of the presentation. Thanks for joining.
Good morning, everyone. Thank you for taking the time to join us today. My name is Rick Lozano, and I will be one of your presenters for financial literacy today for the Los Angeles Public Library. My co-presenter will be Joel Amico, and he'll be talking a little bit later. So we're going to be talking about financial literacy and what it means to be financial literate. Just a little bit overview. I'm a branch manager for Bank of the West, and I've worked with a lot of people in helping them understand their banking, be more financial savvy, and to achieve their goals and plans when it comes to their banking. So what we'll be talking about in this program, financial literacy and why it is important. We'll be talking about the things that we can do to understand our financial situation by creating personal budgets. We'll be talking about checking accounts and how they help you in your planning, different types of accounts as well, savings accounts. We'll also be talking about credit, responsible credit, what's good and bad credit. And then we'll also be talking briefly about identity theft and some of the ways to prevent it and what to look out for. So what is financial literacy? Financial literacy is the ability to understand how to make sound financial choices so you can confidently manage and grow your money. Why is that important? Well, everybody needs money to survive. However, we don't. A lot of people don't get the financial training to really kind of manage their own finances, and so financial literacy is very important. The Federal Financial Literacy and Education Commission, established by Congress in 2003, identified 5 key principles of financial literacy. Being financial literate, according to the Commission, means understanding each of these components. How much you earn, including your pay, benefits, and tax withholdings. How to save and invest, including creating an emergency fund and setting aside money for both short and long-term goals. how to protect your money by buying insurance and knowing how to avoid fraud, and then how to spend wisely through budgeting and comparison shopping. Also, how to borrow money at the lowest possible interest rate, and how to keep your credit strong with responsible repayment habits. So why is financial literacy important? We'll talk about a couple of statistics. The top reasons students give for dropping out of college is and are financial constraints. 1 in 10 students leave college with over $10,000 in credit card debt, and depending on the university and the program, it could be even upwards of 100 to even more, 100,000 or even more. A lot of times people underestimate the length of time it would take to pay a credit card balance. And so it's because it's not primary in your thoughts, you tend to not think about it. But regardless of income, 78% of US citizens in the United States are living paycheck to paycheck. And a Gallup poll found that only about a third of Americans maintain a household budget. Nearly 19% of Americans have nothing set aside to cover an unexpected emergency. And we'll talk a bit about the steps that we can take to prevent that. Among the class of 2019, 69% of college students took out student loans, and they graduated with an average debt of $29,900, including both private and federal debt. Meanwhile, 14% of their parents took out an average of $37,200 in federal Parent Plus loans. Today, you will understand 4 topics about financial literacy. We will learn how to create a personal budget and some of the tools out there to help us. You'll understand how to use a checking account and understand the importance of saving money, and appreciate the importance of maintaining good credit. And lastly, how to prevent and recognize the signs of identity theft. Personal budget. The budget is your personal spending plan. There are 3 things a budget can do. It gives you control of your financial situation by giving you the information that you will need to make good decisions. Understanding your budget is very important in figuring out your spending trends and spending habits. It reduces money-related anxiety. With the pandemic, most recent, a lot of people have come across a lot of money anxiety. And so creating a budget and a savings plan has helped a lot of people to prevent that money-related anxiety. But a budget will also help you visualize where your money is being spent. A lot of times we don't track our budget because it's a difficult situation. It's tough. But once again, understanding your budget and where you're spending is very important to be able to get control of it. So how do you prepare a budget? Think about the budget as kind of your side job. And so you will employ tools and rules to ensure that you're managing your side job correctly. Track your daily spending. There's a lot of ways that you can track your daily spending, depending on the bank that you use. And most banks have some sort of online banking where you could log in from your smartphone or from a desktop computer or laptop, and you could see your daily spending every day. And there's a lot of apps out there that will allow you to track and itemize and categorize your spending so you can itemize them into the separate categories. So looking at the 50-30-20 budget rule, 50% of your budget should be your needs spending. These are your mortgage, your rent, food and groceries, transportation, bills, and medical insurance. 20% is your savings, your emergency fund. your house deposit, vacation fund, Christmas fund, your 401k, your IRA, and even your debt repayment. And then 30% is our wants, right? We all need to enjoy ourselves a little bit. And so spending on our wants is also important, which would be dining out, vacations, shopping, and even Netflix. Determining your income and expenses is very important to categorizing these three areas of expenses. And then also finding ways to decrease spending. So understanding your budget is going to give you a really good insight as to what your spending habits are. And as you categorize your spending, you'll begin to notice trends. Maybe you'll notice that some months you spend a little more on food or gas or going out. And so it's a great way to track it. Very similarly, like if you're on a diet, you want to track your caloric intake and your outlay. The same with the budgeting. You want to track your income, how much money you're making, but then also how much is going out. This is going to give you a good perspective on what you can save. And using the 50-30-20 budget rule and understanding your income and your spending will give you an opportunity to get a control of it. And then also finding ways to increase your income. Now let's talk about fixed and flexible expenses. So your fixed expenses are those that don't change. Typically the things that you can count on every single month that are relatively the same amount. So that would be your utility bills. That may vary depending on the season, but should be typically a standard amount that you're used to paying. Your rent, once again, it's going to remain stable. Your mortgage as well, and then your loans, your auto loans, any other types of loans as well, whether it be a home equity loan or something like that. And then there's expenses with amounts that may change from month to month. So these are our variable expenses. So childcare, groceries might vary from month to month, transportation, gas, and medical bills. And then we have our wants. This is my favorite category, right? It's probably everyone's favorite category. Our wants are the things that we want in our life that are rewards to ourselves, right? Which could be electronics, gym membership, clothing, going out to eat, vacation spending, and entertainment. So the strategy in understanding and getting a good control of your habit is using the pay yourself first rule. Pay yourself first is a personal finance strategy of increased and consistent savings and investment while also promoting frugality. Now, saving doesn't mean that you put everything into the savings account and you live lean, although it could mean that. However, saving and starting to save is a good habit to create trends. When you start your career as a young person, you want to start saving as much as you can, put a little away, but make it a habit. And even if it's $5, $10, $15, $25 a month, just having the habit to know that you are personally setting some money aside for yourself, whether it be for a rainy day, just for peace of mind, or if you have a goal. The key is once again having that goal. The goal is to make sure that enough income is first saved or invested before monthly expenses or discretionary purchases are made. And so having a savings goal is very important, not just saving here and there, but having a goal, a predetermined a goalpost, if you will, of $1,000 to $2,000 to have in order to cover expenses for whatever period of time, depending on your situation. And so once you start learning your budget and tracking your expenses and your income, you'll get to understand how much you can save. What should I put away for? What is my outlay? How much do I want to save for this vacation? The benefits of paying yourself first is, once again, you'll learn to manage your money better. You save money towards those goals. And once again, setting goals is the most important part of the program, because you want to give yourself a signpost that says that you're getting there, you're halfway there, you're almost there, you're there. And then stretching that goal. Maybe this year you save $1,000, but next year it's 2,000, and then you grow it from there. And once again, you want to save for things that you want, but also for emergencies. It's very important that that you have something set aside for times when things come up that are unexpected. And saving pays. Now, if anyone out there has looked at what the rates have been for either CDs or savings accounts, you'll notice that they've been relatively low. And in this environment, they are. But ultimately, when you do save, depending on the type of account, you're going to be making some interest. Interest is a profit made on money that is saved in an investment account. And an investment account could be something as simple as a savings account, a money market, a CD, or an IRA. Compound interest, given enough time, is an amazingly effective tool. Albert Einstein once described compound interest as the greatest invention of mankind. Smart investors put Einstein's insight to work for themselves. Let's take a look at the chart to the right. If you save $1 a day with no interest at 5% daily compounding, if you save $1 a day with no interest, after a year, you're going to end up with $374, $365, just depending on how many days, right? In year 5, at 5% daily compounding at no interest, your investment will grow to $18.25. At 5% compounding, you're doubling almost. No, you're increasing your earned income to $2,073. Year 10, $3,650 at no interest. 5% daily compounding, $4,735. So as you see, interest is going to make a big difference over time, and so it's not something that you're going to be looking at probably every day. And so that's why you want to set short-term, medium-term, and long-term goals. It's largely thanks to compound interest that a mere $1 a day saved from the day a child is born until she's 18 can grow into about $4 million by the time she's ready to retire. If she retires at 66, at 12% interest per year. So interest is a great way to help your money grow, to bring more income. Obviously, the more you save, the more interest you make. So definitely start putting those pennies away. And now I'm going to turn it over to Joel Amico, who's going to talk about checking accounts. Take it away, Joel.
Good afternoon. How you doing? My name is Joel Amico. I am a branch manager for Bank of the West, and I've been in finance for many, many years. Today, I just want to go over checking accounts, and we're going to start off with deposit accounts. First, what is a deposit account? A deposit account is simply an account where you deposit money and you can withdraw the money. Now, there's 4 basic deposit accounts. We have a checking account. A checking account is used for your daily expenses. You could write checks, you could do online banking and do bill pay, Zelle, whatever. It's an access to you whether you're at home or you're at the store. You have a money market account. A money market account is basically a glorified savings account. A savings account that gives you more interest than a plain savings account. Now, with a money market, you do have other options in which you could write a check on it, but both a savings account and a money market are restricted on how many transactions you can do. A checking account, you can do as many as you wish, versus a money market saving, you may be limited up to 6. Then we just have a regular savings account. That's just a savings account you would use to open up for your child, yourself. It gathers some interest, but not a whole lot. Then you have our certificate of deposits. What is a certificate of deposit? That's a CD which is used for a long term. You could have it for 6 months, a year, 13 months, 18 months, 2 years, up to 5 years, 10 years. And basically, you lock in your money in. You can take it out, but if you take it out before its term, you're going to be penalized, and it could be a percentage of the amount you put in. Now, when you have a checking account, savings, you want to keep very, very accurate records. Okay, so you want to record all your transactions. Now, on a checking account, you do have an option. You get your debit card, and you use that debit card at the store to make purchases. You could make purchases online or transactions at the ATM, take money out or deposit. So each transaction that you make, you need to keep a record of it. Okay. In other words, you need to write it down. There's a check register that you would write down, and every time you make a transaction, you go to the store, you make a purchase, etc., you record what you did, how much you did it, and you subtract it from your total balance. And you'll keep this record continuously. Toward the end of the month, you may have to record maintenance fees. What's a maintenance fee? Sometimes you're charged a fee for just having the account, for not doing certain things. And that could be, that could vary. Okay. Anywhere from $3 all the way on up to, $35. And that's just based on the bank that you're with. Any interest. A checking account does give you interest. All deposit accounts have interest. So you may make a little money on your account. It may be $1, could be 10 cents, 20 cents, based on your balance. You want to record that so that you know what your exact balance is. Then you get a monthly statement. Now, you can get the monthly statement by paper, or you can get it via online. And what you want to do is you want to cross-reference all your transactions. So what you have on your register and what's being charged to your account. You want to make sure it matches. Sometimes you may have forgotten that, you did a $50 purchase or a $10 purchase, even a, $2 purchase. And that can throw your balance off and throw your calculations off. You do it a few times, that's huge. You all of a sudden you're thinking you got $10 more, and you actually have less. How do we check our balances? Now, we have online banking. You go to a computer, you pull up your account, you can see all your transactions. We also have mobile banking. You could do it online with your mobile phone. You download the app, check your app out. You can look at all the transactions, how much you have, any interest being paid. I like the fact that I don't have to have paper. I can look at my stuff right online, and I can reconcile my checkbook by matching what I wrote down to what's on the system. Okay, it makes it so much easier, and it's a little bit more accurate. This way, if you have any questions or concerns regarding that, you could always contact your bank and inquire. Now, there are some catches with a deposit account, a checking account. A checking account, you can write a check. Okay, this also works for a money market. If you write a check and there's not enough funds and not enough money in that checking account, you can be assessed a fee. That fee is a bad, or what we call a non-sufficient fund, NSF fee, and that could be charged against your account. So you write a check, we say, oh, there's not enough money in it, we may return the check, and we may charge you $35 for having no funds in your account, or we could, there are other things that we could do that you may end up with a bad check fee. Okay, now getting a lot of these bad check fees because you're not watching your account, you're not checking your checkbook, you're not reconciling, you're not even going online to look to see what you have. This could be a negative on your one, credit, two, your bank credit, three, just with the bank itself. What are the options? What options do bank have? A bank has several options. They can close your account. If you don't pay your non-sufficient funds, your NSF fee, in a timely manner, they can assess an additional fee. Now, all of a sudden, more money's being taken out. You can have, by doing this a lot, there are criminal or civil penalties that could be done. Merchants may not accept your checks anymore. Again, your credit rating or your credit report can be damaged. Okay, and we don't want to do that. Speaking of such, we're going to go into credit. Okay, now let me explain something. There are two credits. Okay, you have a debit card. That's what you get if you use your ATM with. You can go to the store with, and then you have your credit card. All right. Now, a credit basically is you're taking money. The bank is loaning you money once you use your credit. All right. So on a debit card, you notice that there's a little logo on there, MasterCard, Visa, and what that allows you to do when you have a checking account is you can go to the store and you can make a purchase. All right. You can buy that bottle of Coke or your groceries, and it comes directly out of your checking account. Okay, it's a done deal. All right, the money's gone, it's out of your account, over with. On a credit card, when you're getting credit, credit is money that you borrow and you got to pay it back. All right, so as you use a credit card, it goes against the credit card, and then at the end of the month, there's a bill of monies that you owe that you paid. All right. Why is it? What's the difference? One, a credit card, you have to have good credit. You have to have a history of paying money back on time. If not, you have bad credit. They can close your accounts. They can get rid of your checking accounts. They can get rid of your credit cards. Okay. It also means, your credit, loans. You could obtain loans with good credit, maintaining that good credit. A credit card, by paying it on time, you're maintaining that good credit. Okay. And the more credit you have, the better off you are. I know it sounds a little odd, but it's true. What type of loans can you get via credit? Well, we've got consumer installment loans. An installment loan is a same payment all the time, all right, until it's paid off. So you get that when you buy a car. When you go to the store, you do a store thing with electronics, or you get a loan to purchase furniture. That's an installment, same price, same all the way. Okay, you're paying $100 a month until it's paid. And that pays the interest on it and the principal, and you're paying all the way down. Then you have your credit cards. Credit cards are a variable rate. And a variable rate means, it can go up, it can go down. All right, so one month you may pay 15% interest, the next month you may pay a little bit higher. Then you have student loans, normally a low interest rate, and it's a stable loan. And then you have mortgage loans. And mortgage loans can be a variable and it can be a fixed rate. Why? My question: why is credit important? Well, let's look at it this way. It can affect your ability for a job, your housing, a mortgage, even insurance. It's more convenient than paying cash. And the reason is cash has its limitations. One, you've got cash in your pocket, you're going to spend it. Two, you never know, you can be robbed. And three, it doesn't do you any good credit-wise. It lets you make large purchases with a credit card. So you don't have to carry, you want to do a $3,500 payment or a purchase, you want to buy a bed or whatever for $3,500. Well, you're going to have to go to the bank, get $3,500, or you whip out that little credit card and here you go. And last, a credit card is great for emergencies. All right, you're stuck somewhere, you need something, a hotel room, food, car repairs, whatever it is, you get a credit card with that limit. Now, all credit cards come with a limit that you can use to help you out in that emergency. So credit is vital, even though it sounds like it's ridiculous or what, it's hard, it's not, it's something simple to obtain and simple to maintain. Credit. Now, unfortunately, when you get credit, there's always a cost for credit. All right, you've got fees. You have some cards, some credit have annual fees, service charges, late fees. Okay, and that's just the business of doing, using that credit. Some cards, have no real annual fees. There may not be any annual fee whatsoever, but the rate may be a little bit higher. Good switch off. Service charges, late fees. If you're late with your payment, if it's due on the 1st, and you wait till the 30th, you're going to be assessed a late fee. Again, that's the cost of doing business for credit. Then interest. Interest is the fee you pay for borrowing the money that you have. So if you use your credit card for $3,500, even $100, you're going to have to pay the interest for borrowing that money. And there was a calculation done, survey done, and right now, the total U.S. credit card debt is $887.9 billion with a B, dollars. Best practice, don't pay any interest. If you're going to use your credit card for low amounts, pay it off at the end of the month. When you set your budget, you know that you're going to have to pay X dollars for gas, X dollars for food, etc. If you use your credit card, then you want to say, okay, well, I use my monthly expense for gas. Then you take it and you pay that towards your credit card to pay that off. Same with everything else. If you know that you're going to spend $500 a month on gas, food, etc., then you make sure you pay that off. Try not to go over what you have. If you budget $500, try not to use your credit card for over $500 because you want to pay it off. What that does is two things. One, you don't have to pay any interest then. You get a zero balance, there's no interest. Okay? You borrowed money for free. Two, if you have a rewards on that card, maybe a cash back, you get percentages back, points, whatever. Well, guess what? Now that card is paying you to use that card. So if you're getting 3% cash back, you get 3% back. You're not paying anything. Because you use your interest, you have to wait, you pay that, and you have to pay interest. Whatever rewards you've got, you lost it. You're going to get it, but you had to pay more in interest. So you kind of wasted your time on that one. Okay, now, what do? You either pay it off every month. Let's say you can't pay it off every month. So, and you have a balance, you're going to carry a balance for a while. Well, there's a set payment that you must pay, which is called our minimum payment. Okay, that minimum payment. Let's say you borrow, you have a $2,500 balance. Okay, paying 18% interest. So to pay that off would be about 10 years. Okay, 10 years to pay the minimum payment on $2,500. You're looking at about $3,915. So that's quite a big expense to pay for $2,500. That okay? Let's say you're going to get it. You're going to get wild, and you're going to spend your minimum payment maybe $100. Let's say $50. Sometimes they're really low, but all cards they set up to be paid off within 10 years. Let's say you want to cut that down, and that $2,500 you want to add $25, $25 to the payment. It'll take you 4 years to pay it off, but you're still paying $3,258 at the end of the term. So when you pay it off, you're paying $3,258. Now, let's get even wilder. Okay, 18%, still paying that $2,500. Now you're going to pay $50 more. $50. Now you'll pay it off in 3 years. And guess what? Your payment is only $28 to pay it off. You've spent $2,839. So for 3 years, you're spending what, $339 to borrow that money of $2,500. Okay, so again, best to always make more than the monthly payment. You'll save a lot more money. If you're able to pay it off sooner, pay it off sooner. You're going to save more money. Talk about a few tricks here. Rewards. Now, what are rewards? Those are the miles, the cash back, points. Some even have donations. You know, you can donate to XYZ charities. You have freebies. You get a T-shirt when you sign up, music, your gift card. You can get on store cards. You can get 20% plus interest. You know, a high rate. You know, because you got a store card, so it's going to be 20% automatic plus whatever the prime is or whatever they decide. You get pre-approved offers, cash advances, promotional interest rates. So when I say tricks, those are just ways to get you to sign up for that credit card. And some of them are awesome rewards. Okay. Cash back is an awesome reward. Points mile, awesome rewards. Okay. Now let's talk about 5 different ways to use a credit card wisely. And so we charge small amounts to pay off entire balance each month. So that's good. So that's a way to gather more rewards where you don't have to show or have to pay an interest rate. So basically they pay you. Don't make late payments. If you're going to just pay the minimum balance or more than the minimum balance and carry that balance for a month, don't pay a late payment. Even if you're going to pay it off, don't pay it late. Pay it early. Okay. Down the line, you know, after a few months, especially if you use the card or whatnot, you can request a lower interest rate. And yes, they do grant that. So you get a 20% interest rate. You can call them up and say, hey, it's kind of high. You know, can you lower it? And 9 out of 10 times they'll lower that rate, which is great for you. When you have several credit cards, if you have the option, you get 4, 5, 6 credit cards. What you want to do is you want to pick a card. All right. Pick the card that is going to be most rewarding to you. One, it could be just an interest rate. All right. I've seen cards that I had a card one time that was paying 7% interest rate. I'm going to keep that card. I'm only paying 7% rate if I wanted to carry a balance. Or, you got a card that's paying you 3% cash back. Hey, that's great. I pay my card off anyways, or whatever. I got 3% cash back that's going to go back to my card or in my pocket. Or you like miles. So pick a card that's going to suit you and your needs really quick. Okay, I like this card, so I'm going to keep it, and I'm going to use it so I can get my rewards for it. Or I'm going to use it because I have a low interest rate. But what's a low interest rate if you're going to pay it off every month anyways? Use a card that benefits you most. That's the miles, cash back, points. Okay. And then finally on cards, never accept a cash advance unless you absolutely 100% need it and there's no other way. Do a cash advance. But on a cash advance, the interest rate on that cash advance is crazy. So you're going to pay a high interest rate. Plus, you may even pay a fee for doing the cash advance, because now you're not when you do a cash advance, you're not making a purchase and buying something on credit. Now you're taking out literally a loan, and that's why the rates are going to be higher, etc. So it's a higher risk. You're going to take a rate. Try not to do that at all. Okay, you just want to avoid that the best way you can. Now I'd like to go over a little bit on credit report. Okay, I know, what's a credit report have to do with your credit card, with your checking account, etc. It has a lot to do with it. Okay. Now, a credit report. What is a credit report? A credit report is a record of how you have paid your debts and tells lenders, one, who you are, how much debt you have, means all your value of all your cards. If you owe $100 here, $100 there, $10,000 here, everything. Also tells you whether you made your payments on time, how many times you've been late, and it'll tell you. It goes into detail. You've been, late 30 days, 1 month, or you've been 2 months late, 3 months late. It's got a history on it, and that's very important, and that affects your rating. It tells you how many negatives you have, and that could be whether or not public records. If you've ever filed a bankruptcy, if you've ever been sued, and they put it on your credit report. Any public record, meaning any action that's been done with the court, taxes owed, etc. And those are big negatives on your credit. So you want to try to avoid all of this. Now, what is the purpose of a credit report again? All right. Not only does it tell you, how you made your payment, but it's a tool used by creditors, a bank, a mortgage company, etc. That's going to determine a few things. One, it determines whether or not you're going to get a loan. It can determine, how much of a loan you can get. The higher the rating, the more money they're willing to spend on you, take a risk on you. You can get a job. If you have really poor credit, and based on the job field you're in, it could hinder your ability to get a job. An apartment. You want to rent an apartment, what do? They're always going to ask you for a credit report. Every time I've applied for an apartment or to rent, let me see your credit report. Okay. Insurance. Utilities. They want to know if any utility companies ever reported you as not being able to, not paying your electric bill or your gas bill or whatnot. Cell phone service, same thing. You go down, you get a brand new cell phone, smartphone. What do? They're going to run a check on you. It's going to determine whether you're going to pay X or you're going to pay Y. So it's important to maintain that credit, and it's easy. Just literally follow the rules. Make your payment on time. Don't use your credit all the time into what you're going to, if you got a $5,000 limit on your credit card, you don't want to maintain a $5,000 balance. All right. One, doesn't look good on the credit report. And two, it's a killer when it comes to paying interest. Okay. All right. Inquiries and your credit score. I'm going to tell you right up front. There's like 17 to 2,400 ways that your credit is affected in the way you pay things and the way you handle your credit that'll affect your score. There are 3 credit bureaus that are used in the United States. Okay, we have Equifax, we have Experian, and we have TransUnion, and they're divided up. Everybody will pull normally all 3 up, but they're divided by in thirds. 1/3 of the country uses X, another third Y, and then the final third Z. California, unfortunately, West Coast area, we mainly use Experian. The credit score range is based on what they call a FICO rating. Okay, and that's where you hear what's your FICO score. Okay, the system is based on information on payment history, amount you owe, how long you've had the credit, do you have new credit, things like that a decision has been made on your credit solely in part and start understanding what the information is providing. You'll be able to quickly remedy problems on your credit report if you take action on these things. So it's best to always you get a free credit report every year, pull it, download a credit app. There are several out there. Each I know that Experian has one. You pull it up, keep track of your credit, and it'll show you everybody that's looked at your credit, through inquiries, everybody that's any account that you've had and any account that you currently have. Okay, now let's talk about scoring. Okay, there are a few scores that can damage you, or a score that can most favorable to you. Okay, we're going to start with excellent score. What's an excellent score? On a FICO score, an excellent score would be anywhere between 750 to 850 points. Okay, then you've got, now by the way, 30% of the people have that 70 to 850. Okay, a good credit score, 700 to 749. We're looking at 13% of the population. Fair credit, which is 650 to 699, and that's 18% of the population. So that's where most people are normally in. Then you have poor credit. That's 550 to 649, and that's 34% of the people. And then you have bad credit, 350 to 549. Now, fair credit, these credit scores are going to determine a whole lot. You got excellent credit, there's no real risk on you. Okay, they're saying, oh, great, I'll do it. I'll give you stated this, whatever you tell me, no problem. All right, bad credit, you filed a bankruptcy, or you've failed to pay and you had a bunch of charge-offs, which means that the bank or the financial institution can't collect on it because you won't pay. They haven't served you. They can't find you. Those are really bad. They're hard to bring up. Okay, but it's possible. All right, so it's not. You just need to understand that once you have poor, bad, fair, credit, you have to talk to people, talk to a banker, and how to increase those scores. Okay, they have agencies that will help you, clean up your credit. Okay, current credit, it's hard to get rid of. Past credit, it's a little bit easier. Okay. Now, what I'm going to do is I'm going to go ahead and I'm going to turn it back to Rick, where he's going to handle and take care of identity theft.
Thank you so much, Joel. Wow, a lot of great information there. And we're running a little bit close on time, and I want to make sure that we leave enough time for questions. So I'm not going to breeze through identity theft, but I think it's an important topic for us to cover. But we'll talk briefly on some of the points here. The Identity Theft Resource Center in 2019 stated that there was over 3 million reports of fraud in the United States, with the majority of those being identity theft. So identity theft is really the biggest form of fraud in this country. 1 in 4 Americans are affected by identity. So it's more likely that several of us on this call or in this training have had some form of identity theft. Unfortunately, identity theft and fraud has become increasingly sophisticated, harder to detect in some ways, and it preys upon the vulnerable. The pandemic has accelerated a lot of online use, online purchasing, and so with that, identity theft and fraud has also ticked up as well. So what is identity theft? The act of stealing, excuse me, your identity in order to order new credit cards, make counterfeit cards or checks, and even go on a spending spree in your name. I've had identity theft at one point in my life, and somebody bought a car in my name. Luckily, they paid it off, so that actually worked out for me. But it doesn't work out for most people. But how do you protect yourself? You've done all this work to create your budget. You've got control of your spending. You've got your checking accounts. You're monitoring everything. You're using your online banking. You're working hard to maintain that good credit and that good budget to protect yourself. So what do? You get a lot of information from credit card companies. You get your statements in the mail from the banks. Go paperless. That is a very easy way to limit the amount of exposure of information, financial information that's out there. Shred personal information. A lot of banks, if you bring them maybe a stack of forms that you need to shred, they will shred it for you. Also, investing in a shredder for home is also a good way to protect yourself. Print only what is necessary on checks, not too much info. So here's another topic of discussion. Online banking, and most banks have this, will allow you to make payments through their online banking system where you don't need a paper check. Why is this important? Well, through the online banking system, it sends out a check with your information to the payee, but it also creates an electronic trail of that item. If you write a check, you put it in the mail, you put that in the mailbox, nobody knows where it is, right? It could get lost. It could be pulled out of the mail. It could be used. It could be bleached or washed and new information printed on it, which happens quite a lot, unfortunately. So using your online banking tool to send payments and checks is a great way to avoid that. And then create very strong passwords and change them often. There's a lot of software out there that will create passwords for you and password keepers to help you keep track of everything. So don't use your dog's name 123, your kid's name, and their date of birth. Those tend to be easy to kind of pick out for fraudsters. Once again, they are becoming increasingly sophisticated and they have a lot of tools to be able to break passwords. So what are the new forms of identity theft? We've already talked a bit about checks being taken, but there's also electronic forms of identity theft, and we'll briefly cover this. Phishing is an attempt to fraudulently acquire sensitive information such as usernames or passwords and credit card details by sending an email or acting as a trustworthy entity in an electronic communication. So you get an email from your bank saying, or from Amazon or from Apple saying, hey, we noticed that there's been some activity in your account. Please check this link to reset your password. Don't. Banks typically, and those companies don't send you an email in those regards, and they won't reach out to you, particularly banks won't. We won't call you to get your password information or anything like that. When if you have a concern on a call with someone that's asking for information that's stating that they are your bank or someone else, take down their information and then call your bank using your resources to verify. Farming, redirecting a reputable website's traffic to another bogus website. This is also very common. There's a lot of spamware out there that create files within your computer that will redirect traffic to a fraudulent website. Be wary of those. Keep your software and your spam software up to date on your computer. There's a lot of ways that you can ensure that you have protections in place on your personal devices. SM phishing or smishing. Thieves are employing a sneaky new trend to get your personal info by sending text messages to your mobile device that impersonate a reputable contact and then direct you to a dangerous website with the goal of stealing your identity. Once again, always, always, always question any type of link that is emailed to you asking for personal information. And then phishing. Voice calls that are made to your landline or mobile phone are an effective way for thieves to get your information. And unfortunately, a lot of elderly clients experience this type of fraud because the person on the phone sounds official. They have a sense of urgency, and so always be cautious when talking to somebody on the phone. Do not provide them information. Reputable companies know that there is a lot of fraud and will not ask you for your personal information. They have processes to ensure that your passwords and your accounts are secure. Thanks so much for taking the time today to sit through this presentation with us. We had an enjoyable time presenting the valuable information for you. I'd like to open it up for questions now for myself or Joel.
Oh, sorry about that.
There we are.
Big faux pas that I was on mute. Okay. Anyway, sorry. Someone had the first question was, what is the recommended savings account with the best return on interest?
Oh, I can go on that one. Can you hear me?
I can hear you.
All right, great, awesome. That's a money market account, okay? And there's two reasons. One, it's an account in which you can take your money out. The more money you have you deposit in a money market account, usually the higher the interest rate. You don't get penalized for for taking out that money. CDs are great for a long term if you don't want to touch the money, you want to lock it in, and you get usually a bigger return on your money. However, you lock it in. If you take it out, you're going to lose. Normally, the rate between banks is like 3% penalty. Okay, but money market is the best way because you have access to it in case you need it. My recommendation: money market and CD.
Okay. And so it seems like if you are interested in something like that, you definitely want to ask some questions to the banks you're working with. And maybe those questions would be among, what is the penalty for withdrawing money? Are there other questions that come to mind that are important to ask?
It's always good to have a great relationship with the bank that you work with. And Joel can attest to this too. We love clients that are proactive and are taking the steps to ensure that they have that they're doing the right things for their accounts, and they ask questions. We want to make sure we preempt any issues by providing information up front and monitoring on an ongoing basis. So having a good relationship with your bank is very important.
Awesome. Thank you. The next question we had was, do you recommend having multiple credit cards, or how many credit cards should a person have? I think you touched on that a little bit, but when you talk about credit.
Credit cards, there's no, you can have as many credit cards as you want. There's no real penalty for it. The thing is, you want to have one credit card that you use mainly, and then it's always best to have a backup. Okay, so the very, very least, two credit cards. One you would always use, but what if something happens? Let's say you lose that credit card. What are you going to do? You're on a trip and you lose your credit card while you're on a trip. Get that second card. You have that second credit card. So the best, which is the least, two.
Okay, great, thank you.
Yeah,
Sorry.
one important thing about credit card exposure is if you have too many credit cards, the limits on those credit cards can be considered your exposure, part of your debt to income. And so if you have several credit cards, you may not have balances on all of them, but if you have a $5,000, a $10,000, and a $15,000 credit card, all of that will be part of your debt to income. And so when you go for that mortgage, for that auto loan, that's going to be used as part of your debt to income, and could affect you negatively when you're applying for credit.
Okay,
Yes.
thank you. Good to know. Another question came up is what do you think about, it says digit savings accounts, but I think maybe digital savings account? I'm not sure. I don't know what digit is. Maybe you do.
Online, I believe they're saying the difference between an online account versus an account that's at a brick and mortar, a bank.
Mm-hmm.
There are online banks where you never see them, you never see a person, and you can do it. Sometimes you get higher rates on those, but again, those are online. You never see a person. So I want to go to a bank where I can walk in, and if I have a question or an issue, I want to be able to talk about it. Okay. Anytime you have a relationship with your bank, my personal opinion is, and I do this myself, I want to talk to my banker. I want to sit down with my banker, at least every quarter, once a year, and discuss everything. Am I saving right? How much? What's going on? Best way.
Okay. So I think the rule of thumb there is to make sure that you do your research if you're investigating any kind of online banking outfit. You may have a personal preference, but definitely good research is something that may be necessary.
Right. Can't talk to somebody is an issue.
Okay, so another question that came up is someone asked, what about cashless apps, payment apps? Are they secure? Do you recommend using them?
And so when it comes to cash apps, say for example like Zelle or Venmo, those transactions tend to be more secure. And the reason for that is think about it like this: when you write a check, as I mentioned earlier, you've got all the check information that's out there. The check is floating around. You've got your address, your checking and routing number. It's out there. They can take that information and use it against you. When it comes to Venmo and Zelle, those tend to be more secure because they're encrypted to go out to a specific party, and they're trackable. And that's the most important part. When they're trackable, we see where they went, where they came from, and where they're going, and how to get it back in a lot of cases.
Excellent. Thank you for that. And then someone else asked about savings accounts for college.
Well, a savings account for college, when you're looking at a savings account, there's just two that you really want. Okay. Actually, there could be three. What's going to give you the most bang for your dollar? Okay. A lot of times, if you're going to save for college and it's going to be 2-3 years before you go, or 5 years, CD. Use a CD. Okay. If you think that you may need the funds before that time, then term them. So in other words, instead of getting a 5-year CD, you might want to look at a 12-month or a 13-month CD. If you're even more worried that you may need it before that, or you just want the flexibility, then a money market. Okay. You could even just use a regular savings account, lower interest, but it's still the same. You could take it out whenever you wish. It's just going to be on your preference and on your need. Again, these are one of the things if you're going to be saving up for college, just want to open up a savings account or a money market account, talk to your bank. Talk to the banker. They'll be able to explain all the options. And then you can make an informative decision on what you think you need best. But the key is talking to your banker.
Okay. Well, thank you for that. And I think there's another question that came up, and that is in regard to Bitcoin. I don't know how prepared you are to answer this, but it says, what do you guys think about Bitcoin?
So, I can give you my estimate on it, and then Joel can step in as well, because I'm sure he has some thoughts on it. Bitcoin isn't currently regulated, and because it's not regulated, the protections that we have in the system, in the banking system, for example, that is regulated, are there to protect consumers. And because Bitcoin currently isn't regulated, it's not something that is considered safe. Yes, there are a lot of people that are making money on Bitcoin, and there's a lot of talk about that out there because of the news recently. But if you're conservative, like we are at banks, we steer clear from things that don't have consumer protections. Joel, do you have a take on it?
Same thing. If it's controlled by one person or 10 people and they all said, you know what, let's up and pack away and we've got the money, what are you going to do?
Okay.
Where are you going to get your money back from? Nobody.
Yeah. Definitely things to think about. Thank you for that. And we just had a lot, I guess it's basically a different version of the same question. I think you've already answered it. Are payment apps safe to use? Are they better to use than credit cards?
Payment apps, okay, you understand, payment apps are not for making your purchases, etc. Okay, payment apps, Venmo, Zelle, things like this, you're going to send to friends or relatives. Some businesses use the Venmo. That's great. If you're the business and you're accepting the funds, that's up to them. But normally on Venmo, Zelle, things like this, you make a payment to somebody that's not a friend. You just say, hey, Zelle me $100. Understand that it's directly out of your account. Boom.
It's gone.
It's gone. A credit card, you got to remember, if there's any fraud done while using that card, because on a debit card, they get that card number, they use it, the money's out of your account. On a credit card, remember, it's not your dime. It goes to the processing and all this. You get your statement, you look at it online, and you can say, hey, wait a minute. Okay? You're not inconvenienced with that money being out of your account right away. So my opinion, friends, family, trusted members of businesses, Zelle, Venmo, whatever. Normal purchases, use your credit card.
All right, great. Thank you. And I think that concludes the questions. There's just one more for us that asked if the presentation will be available to watch again. Yes, it will. You can go to our YouTube channel. So if you go to YouTube, look for LA Public Library, and that's where you can find this presentation again. And that concludes our program today. So thank you so much, gentlemen, and Bank of the West.
Thank you for having us.